Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Prerana, Seth, Fixed Income Strategist. With an objective to empower you with investment insights, on this program, we discuss various perspectives that are shaping the global investment landscape. The US dollar has weakened by 1.17% in the first quarter of this year, despite having quite a volatile quarter. The key drivers of the dollar performance fluctuated between the interest rates and risk sentiment in the first quarter of the year. The interest rate driver dominated particularly from the beginning of February to the first week of March, when front-end interest rates initially rose on expectations of a higher Fed fund terminal rate. In fact, the 2-year US Treasury yield had reached the highest level since 2007 on 8th March this year. However, immediately with the onset of the banking turmoil, the front-end US Treasury yields witnessed sharp decline due to the rise in dovish Fed expectations in reaction to the financial stability risks. The US dollar initially tracked the decline in US Treasury yields, but yet saw bouts of strength as bearish market sentiment boosted the currency's safe haven characteristic. In the past few days, market concerns over financial instability have stabilized, and banking sector crisis appears to have been contained. At the same time, front-end bond yields have seen upward correction post the March Fed meeting, as markets have started to price in probability of another rate hike in May. However, the US dollar has continued to weaken during this period. The waning of the bearish sentiment has supported the recent dollar weakness. In the near term, interest rate factor could again take charge in driving the dollar in our view. In this quarter, we expect the dollar to stabilize a bit, and we could in fact even witness episodes of brief US dollar strength as markets price out the excessive Fed rate cuts. As we had highlighted in our last weekly podcast, we expect the Fed monetary policy to be tighter than market expectations in the next 3 months. However, at the same time, we still believe that the dollar will continue to remain weak. In the second quarter of this year, the ECB is still likely to raise interest rates more than the Fed. So in summary, the dollar still should remain weak in the near term. But the trend could break if we do witness reoccurrence of the risk-off sentiment. As always, thank you for listening to our weekly podcast. Hope you find it useful. If you do, please share it with your family, friends, and colleagues. For more information, please reach out to your contact at ADCB. You can also log into our website www.adcbam.com. This is Prerana signing off.